Hi, I'm David Buckland and welcome to this week's Video Insight. Global markets are readying for the biggest unwinding of risk I've seen. Sydney clearance rates head toward historical low as credit bites. In recent days, we've been bombarded with many negative financial headlines. Is this in reaction to the 5 to 7% decline recorded by many global stock market indices in the month of October 2018? Or is it in reaction to the possibility that the Australian residential housing market has entered its first sustainable bear market in many years? Auction clearance rates are now likely to breach 40% on the downside, the lowest level recorded in nearly 30 years. Back in July and August '89, Australia was about to experience the recession we had to have. Interest rates were typically 17% and auction clearance rates were around 1/3. Over the past 3 decades, the Australian household sector has become one of the most indebted in the world relative to our disposable income at 200%, as seen on the graph. We've also become extremely wealthy. It seems to me likely that the secondary effects from any scare to the Australian consumer could yield quite negative ramifications. Australia has enjoyed a wonderful tailwind for many years from the pull-up effect from China's growth, combined with the wealth effect from declining interest rates and rising house prices. Nevertheless, I believe consumer stocks, including discretionary retailers like JB Hi-Fi, Myer and Nick Scali, could start to experience a headwind from 2019 as mortgage stress is likely to increase. Consumption, which has held up well, will come under pressure as the savings rate has recently fallen to levels similar to those that preceded the GFC. I suspect some degree of consumer pain will broaden its tentacles and wouldn't be surprised if the bank's provisioning for bad and doubtful debts have to increase. While it's impossible to know whether the Australian consumer just hibernates temporarily, it is important to point out that currently Montgomery's domestic funds are conservatively positioned, with around 20% of the portfolios in the safety of cash, virtually no exposure to consumer-related stocks, and a continuing very modest exposure to the banks. Thanks for watching, and you can continue to follow us on Facebook and Twitter.